Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, generally related to three different topics: wealth building, finance. Yeah, it's usually I say finance, wealth building, finance, or commodities. So let's dive in there. Let's see what people are talking about, what they're sharing on social media, and hopefully it provides a bunch of value to both myself and everyone else who's viewing. So let's dive in. Let's see what they're talking about. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, that is where I go deeper into individual sectors, individual companies. I do a lot deeper analysis than even what I do during these kind of Twitter talks, and kind of try to connect everything together. That's kind of what I try to do. And then we find great entry points to potential investments that are hopefully hugely leveraged and asymmetric in nature for investments. So looking at Tavi here, we've seen hardly any growth in commercial and industrial loans in the past 2 years. One reason, a deeply inverted yield curve creates an extremely challenging lending environment for banks. Instead, we're witnessing a resurgence of a trend where these financial institutions are utilizing their capital to accumulate government securities. These institutions are gradually evolving into the primary lenders of government debt, reminiscent of the 1940s when the yield curve control was necessary to enforce financial repression despite inflation surpassing historical norms. Treasury holdings by US banks are now standing at 1.5 times the total outstanding commercial and industrial loans. So here's your US commercial and industrial loans. You can see no lending growth. I also think one of the main contributors is the affordability of housing. The demand is there, the imbalance in the market is there. What is stopping this lending growth, in my opinion, isn't just the yield curve inversion, but also the affordability of homes. And generally in history, what the Federal Reserve would do is if we got a lot of inflation in the system, they would raise interest rates to kill off monetary expansion credit growth. So the monetary side, which is this lending here, that got cut off. You can see all of the loans in 2020, how that skyrocketed. That was very inflationary. Then they tried reeling it in. We've gone on up from 2021 to 2023, but we've really slowed down lending growth in the system. You can see it multiple times here. And that's increased rates, not much in terms of affordability, in terms of loaning against residential real estate. The problem is we've got the fiscal side running all these deficits. And with interest rates going up and where the debt is, we are still getting a stimulative effect from fiscal side. So the monetary side is really slowed down. It's coming from the fiscal side. And what I would say is if they slow fiscal spending, yes, we're going to get a slowdown in the system. They're going to lower interest rates, which will kick back this to the upside, and we'll get more growth in lending. So it's either going to come from fiscal or it's going to come from what we're looking at here. This will start to go back up. The demand is there, the affordability is not, in my opinion, for the housing market. Here's Palladium, and I'm getting very much more interested in Palladium than what I have been. It says, since identifying the tweezer bottom pattern in February, Palladium has experienced a bounce and is now encountering resistance again. The tweezer bottom, I'm not familiar with the tweezer bottom, but tweezer bottom is a bullish reversal pattern with 2 consecutive weekly candles with the same low occurring after a price decline. This pattern suggests a strong rejection of lower prices and a potential turning point. Currently, Palladium is at a critical resistance area. These next few weeks are pivotal for the metal, as breaking above this resistance is necessary for it to overcome its long-term downtrend. Well, we're up against support, and what he's missing here is there's a long-term support level that goes just under where we're at today. It's supporting us. It's the tops of previous highs back in history. So he's zoomed in too much. I know we've got a downtrend line. Yeah, I think we are going to break this to the upside. I also think that we're going to break platinum too. So I think the whole platinum group metal, the whole base metal complex is about to break to the upside. But yes, palladium does look very, very good. Calibri trader, he says, when everyone says price action is hard, you must do what everyone else is not doing. That's why I came up with this price action manual. Well, what this is a slingshot. You've got support, and what it does is it does a false breakdown, and it gets everybody on the wrong side, and then it slingshots upward. You can see these big. Well, they're not technically bullish engulfing candlesticks, but they're big uh, candlesticks going up. They're very forceful, and that's quote the slingshot. It brings you in. You probably get people who try to short here, but then they get squeezed on the way up, and that is what provides some of the force or buying pressure is those shorts covering. It says after the bullish engulfing pattern is formed, the next candle is long and marks the bullish bias of the market, except there's no bullish engulfing candlestick in here. There's nothing engulfing it, at least candlestick definition. This is awesome, guys. It says what the start of a metals bull market can do to a man before and after. And that's the start of a metals bull market. I love it. So the BJ, Brent Johnson says BJ's timing is wrong. He said decades. It won't take decades for the USD to significantly devalue against physical gold. Meanwhile, this rabbit guy here is correct. So here's the rabbit guy. He says milkshake works until half of the major countries of the world stop participating in using dollars for petroleum trading. Nobody wants UST anymore. Milkshake boys will find out soon. It was never a milkshake, just a frosty from Wendy's. So come on down. We've got Peter here, and he says gold has been hitting record highs. Why there's a bullish case for silver too? Well, we know there's a bullish case for silver. He says the typical pattern for silver is gold is the leader. Gold, breaks out first, and within a few months, silver slingshots. You are correct. And if we go and we look at those patterns, gold's obviously already broken out. It's cruising. Silver just broke out here the past couple weeks, and I do think the slingshot is on. I like that he used the word slingshot. I had to share this because he used slingshots. All right, coming down, we got Art here. He says China has bought enough gold to equal 1/3 of the Federal Reserve's strategic stockpiles over the last 2 years. This is Chinese gold imports surge as 2024 begins. Non-monetary gold imports into China just ripping here, guys. Look at that. Look how much they're importing. Look at 2024. I mean, we're in April, and this thing is already up here. That's ridiculous. Um, Coming on down, China is stockpiling everything from copper to oil to nickel to iron ore. That's what you do ahead of a currency devaluation. China is preparing something major. I think they're right, and I think he's right. All of these big, long-term, big picture view um, charts that I see are signaling something massive is coming. And I am doing the same thing that China's doing. I'm literally like increasing stockpiles of all these commodities or commodity equities in the portfolio. I'm doing the same thing as China after, reading this and kind of figuring this out. They must have the same chart readers similar to me or something, or the same idea, same type of approach. But we're seeing China stockpile everything here, guys. And I am surprised at what these charts look like on a longer term perspective. Everything looks like it's about to just rip. We're going to know why after the fact, but China could be one of the entities that is creating the chart patterns that I'm seeing. Very well could be China and other countries stockpiling as they know that they're going to dump. Maybe it's dumping dollars or dumping bonds or the combination of both and that America is going to have to do something extreme, and it's probably going to impact the value of the currency in a negative way. So you'd rather own commodities. Yeah. Rick Rule, he puts in here, the stock market is a device for transferring money from the impatient to the patient. Totally agree with that. And I'd say it's taken me some years to learn that. I was very impatient when I was a new investor, trading in and out, getting scared emotionally. Now I just sit and wait, guys, because this is a completely true quote. Because if you just sit there and you don't worry about the short-term volatility, you buy on the pullbacks when things are down. That's how I've made the most amount of money. He's exactly right. And I guess I'm proof of that, or my portfolio is proof of me of inaction being the best action. Say in finances, here's a hard truth. Your home is not an investment. I don't include it in net worth calculations. 30% of homeowners are house poor and unable to max their retirement contributions. Retirement should come first, homes second. Sometimes I question if homes are worth buying at all. Well, I mean, that's an opinion. My opinion is the exact opposite of this person. I will tell you my experience and maybe a few others' experience. A lot of people who have experience under their belt or older individuals, the first thing that they'll tell you is get in a house, get it paid off, kind of get that under your belt, and then worry about whatever else is next. That's kind of the Dave Ramsey approach. I've heard some other older individuals say that. I think the name of the game is to get into the housing market and get your costs locked in at a really low rate. That was my mentality when I did it. And right now, my mortgage is cheaper than how much my food bill is. My mortgage is like a third of what rent would be. So when you look backwards, I think what someone should do is say, okay, if I bought a house and take one cycle back, so 30 years ago, that's we get 30-year mortgage rates. Look back 30 years and ask yourself, if I bought a house 30 years ago, would I be better off today, or maybe even 15 years ago doing that and or renting? And I would say for the majority of people, you'd be better off buying the house than you would be renting. And if you do it really early and your house is paid off after 15 or 20 years or 30 years, whatever it is, you get to live in it for, a lot less than you would be renting. I am not in the renters camp at this time. I still think that it's probably better to buy a house, lock in your costs, and ride it. But that's me. I also don't think that you should be maxing out your retirement account contributions necessarily. That is a lot of money. So if I were to max it out, just giving me as an example, let's say I do a Roth IRA or a backdoor Roth, depending on how much money you make, and you have the full capability if you've got a side business. I think the maximum you can put in for employer and employee contributions, I think it's around $66,000 for 2023. I think it's 69,000 or 71,000 or something like that for 2024. So that means that I can put in 71,000 plus another 7,000. So that's like $78,000. Do I really need to max out in my retirement account contributions every year, $78,000? Maybe. I don't know. You can also take after tax contributions into a 401k and put them in a Roth 401k. So you can also put in way more money depending on how much you put in pre-tax and put after-tax Roth 401k contributions. You can also do that even if you're working at a W-2. You don't have to stick to the $23,000 max, which is so that's the max for pre-tax. You can put after-tax money in it and it would be, quote, a Roth 401k contribution. You can also put after-tax money into a 401k and then transfer it into a Roth IRA if it's after tax and not pay any taxes. You can just go right on over. So long that the company that you work for allows that. They may not allow that. So you might have to wait until after employment with that company and roll it into a Roth IRA. But you can take after tax money, make money on it, and then roll it over into a Roth IRA later. And the original amount and your gains will go into a Roth IRA if it's after tax money in a 401k. Just an FYI, I'm not a tax specialist, but that's how it's worked for me. But I would say I don't know about 30% of homeowners are house poor. There's probably a bunch of decisions that are made by people that may not be good financial decisions, like buying new cars and taking loans to buy new cars. There's a bunch of different things that I would say are not good decisions. But maxing out your retirement account, I mean, that's a lot of money. That's all I'll say. If you're trying to max out everything. Game of Trade says, do not mistake a lag in recession for a canceled recession. History points towards a second half 2024 economic downturn. Buckle up is what he says. Now, the only thing that I'll say with a lot of these, I'm just going to give you guys the data. I'm not going to sugarcoat or do anything. Housing market bust was this one here. Housing market bust, housing market bust, housing market bust. These are all housing market busts for the most part, outside of 2020, outside of the year 2000. Something is weird with this current yield curve inversion. It's really weird, and I think it's probably being driven by fiscal spending and credit debt problem. And maybe that has something to do with it. I do not think that we have a housing market bubble because we do not have the inventory for it. I agree that affordability is bad, but affordability isn't the driver of a bubble. The lack of affordability is signaling maybe a couple of different things. It signals if you have lack of affordability and no inventory, it means the housing market is tight, number one. Number two, it could also signal that we've got something with our bond market that has a problem. And higher interest rates are forcing us, everyone, into a higher interest rate environment where affordability is going to stay bad. But the inflation doesn't go away because we have a spending problem, a debt problem. And I don't know if I've looked at history with debt problems and what the yield curve has done under those different market conditions. That'd be an interesting one to look at. China and India have typically vied over the title for the world's biggest gold buyer. But that shift last year as China consumption of jewelry, bars, and coins swelled to record levels. China's gold jewelry demand rose 10%, while India's fell 6%. Chinese bar and coin investments, meanwhile, 28%. So China consumes more bullion than India at this current time here for the past couple of years. Average Bitcoin mining costs surge on April 20th with the halving. The average BTC mining cost is now $93,500. This should do wonders for the top public Bitcoin mining companies' share prices. Now, this isn't what worries me. What worries me is what if Bitcoin stays below $94,000 a Bitcoin, where they can't really make money on it? So, does the network start to shut down around the world? What does it mean? And has anyone really thought this through? And what do the fees look like if the fees are transferred to the people transacting? And those fees, I think, could be astronomical depending on where the Bitcoin price is. That's just interesting. Here's Hartnett, the 1970s chart when gold ruled over all. So distinctly remember in 76 in Philadelphia, things were great after years of high inflation, but work. Says the bicentennial is coming, so they will do what they can to make things feel good for folks again. The world is watching now. So here's the ranked assets in the 1970s and the performance of those assets. Gold crushed it. You can also see that commodities underneath performed very well as well. Commodities have been, you can see that they're all in the top here for the most part. And then if you look at the bottom here, technology was the worst performer, minus 17%. US dollar was bad. Tech was down 20%, minus 37%. This is like year after year, guys. Gold had a couple of years where it pulled back in 75, 76. That was a recovery phase of real estate. And then we had, again, US dollar going down and tech. So tech, you can see, was at the bottom during the recovery phase. You can see tech went up. And that's crazy how this cycle moves. This was a big expansionary phase here of real estate. Then we went into a crash of 75, 74, 75. That crash went into a recovery phase, which was these areas here. Stocks and tech do well in recovery phases. This here is more or less what I teach people about the cycle and where to be. But we're at an inverted yield curve. Gold's taking off. I think this is going to be one continuous move. And that's where the hardest part to get right here is there's a lot of things in history that you can't really compared to where we are today. You have to go outside of the United States and start looking at like emerging market countries and what they did with their currencies. So it's a lot different. And I've studied more of the United States stuff, less so emerging markets. And I'll have to start looking more in emerging markets as well. Coming on back, we've got Semper. Take a look at gold compared to gold miners in this format. They all look similar. It's like the market still has zero faith that the rally in gold is going to survive. The algos were not programmed for an environment where gold and real rates diverge. I agree with that. And here is the KGC, the scatter plot of GLD versus KGC color coded by year. I don't know which one's which, but I agree with this here, where gold and real rates diverge. I don't think anything's ready for that. Not programmed like that. Here's Michael. He says, despite long-term, not too positive outlook for oil, historically low capex should support for oil prices in the foreseeable future. So this is the energy capex as a percent of operating cash flow, and it's way down here. And here's the average looking back at history. So we're underinvested, guys, and we're not dumping that cash flow back into capex. The Dow gold ratio has given just two major buy signals for silver since the gold standard was abolished over 50 years ago. It just gave the third buy signal, guys. So here they are, the 7-year rates of change. What we want to see is we want to see the rate of change going upward. So there's a positive one here and here where we're coming up over the 50% line, which is a buy signal. We have another buy signal here, boom, ripping. Oh, sorry, this is a buy signal. Buy signal, buy signal. And this is because this is a ratio. Buy signal here, boom. And then we just hit a buy signal recently as we come where gold starts to outperform the Dow, which is that ratio. Silver's ready to rip here, guys. And what he says here is, you want to know why silver has failed to take off all these years? The answer is here. It only takes off when we see true capital rotation. That's money rotation. That means that Dow to gold ratio must break down. It now has, and this Dow to gold 7-year rate of change indicator must turn negative. It now has. Simple as that. Forget narratives and fairy tales. They're a waste of time and energy. It's simple. Capital flows and mathematics. You forgot an E, but yeah, it is. This is what I proposed a long time ago with inflation, interest rates, An increasing interest rate with inflation. So inflation is driving that increasing interest rate, rotates capital differently. This also correlates, what he's talking about correlates to this chart that we just went over here. This cycle, as it moves through, is rotating capital between technology stocks, gold, and then it switches when the environment changes to a recovery phase. But then we went straight into another expansionary phase of real estate, which that expansion phase of increasing interest rates and all that stuff is going to push money over into gold and silver and some of these other assets. It's all interconnected. And that interconnected nature, he's showing that movement between assets with this chart here. So it looks absolutely fantastic. So what we want to do is we want to use that to our advantage if we know that capital flows is going to move into silver or other assets. Use that to our advantage. That is something that we want to use. Oh my goodness, Kathy Wood. So it says it's a difficult to make predictions, especially about the future. Niels Bohr. And here's Kathy Wood in 2020. This is July of 2020. This is when I was evaluating all of my oil stocks, and this is what a lot of people were sending me on Twitter. It said oil demand probably hit a secular peak last year, and thanks to EVs, now is in a secular decline. Though ARK has no formal forecast, I believe that oil prices are on their way back to $12, the level reached after the 1973 oil cartel crisis, or lower, now that EVs are taking off. This is where I think Trader Ferg said that this is going to age like chicken sitting in the sun. um, yeah, this is absolutely ridiculous. And when you look back and you look at some of the calls that people made, I just shake my head. I'm surprised at how big I went and when I did it, when all of this crap was circulating. I totally disagreed with this, and it was good that I did. Dow gold equals 1. It says if you're going to use the DXY to infer gold's direction, just look at the ratio. If gold is beating the DXY, it's going up, plain and simple. Check out the recent breakout and historical implications. So we just broke out of gold beating the DXY. He says that's a huge deal. I agree. And we're to go higher in terms of the dollar. You're correct. The FI couple says incomes needed for family of 4 to live comfortably. Massachusetts needs $300,000. Hawaii, the same thing. Connecticut, New York, California, all above 250,000 bucks. Do these numbers surprise you? I think they're a little high, but I'm sure those numbers are probably accurate if you're going to purchase a house today. The thing is, a lot of people purchase homes at different times. So the cost of living in a certain location varies dramatically based off when you purchase some of your largest expenses in your life. And that's one of the things that I'll just say. The largest expense in your life, people just, they don't even think about it. They just buy it when they want to. There are huge differences of when to purchase a house. And if you bought it at a really good time, your cost of living could be 50%, 75% lower. If you bought a house at the bottom of the market in 2011 or 2012, and then you refinanced it on a 30-year mortgage in 2021, you'd be paying like nothing. I mean, your house payments would be like 400 or 500 bucks a month, if that. I mean, it would rival your property taxes in most states. So, I mean, now since you've got a huge demographic coming through home buying years and we've got increased interest rates, you've got high home prices and high interest rates. Of course, the affordability is going to be the worst when you've got the largest demand for something. Here's JC Parrots. He says, "How about when you look at it like this?" And I agree. That's how I look at it. It's a support region that we're breaking to the upside, and this is your 1, 2 hump, 3 hump consolidation. We're ripping here, guys. This is a continuation pattern here. This is a continuation. We just went through a consolidation, and we're ready to rip. This thing's going to rip, and it's going to make people a lot of money. It's going to make people a lot of money, and that's priced in Indian rupees, just to let you know. Coming down, the top chart is the relative strength line of energy relative to the S&P 500. The bottom chart depicts the S&P 500. When energy sector outperforms the S&P 500, it can signal that the S&P 500 might be topping out. In recent episodes of the Stock Market Brief Show, we discussed how this was occurring and that the S&P 500 had not been affected. Well, there you have it. Now it's affected. So this is the ratio going up, XLE outperforming the S&P, and there we are going down for the S&P. Energy is outperforming the S&P 500. So it says, Kevin says, for me, the 2020 peak was good enough for commodities, especially uranium versus NASDAQ composite, excluding the big seven. This was the peak for the cycle and the best time to start loading up. But given the market has given many a second gift and opportunity to switch between tech and commodities. He says the Bubblicious 7, led by NVIDIA, decided to blow out once more. Not Tesla, which clearly ended its leadership a couple years ago. But just look at that chart. Now is so similar to 2000 and the telecom, biotech, semi.com bubble. Only now it's AI and crypto stupidity. Bear market in commodities is ending due to depletion and new demand growth from the need to upgrade the electrical grid the world over while moving to battery-powered everything. These big trades, the ones that matter the most in one's 30 to 50-year investing life, you want to be on the right side of this and stick to the plan until we peak in the commodity bubble that will be led by gold and silver blowing out on the back of a global currency crisis. They are all crap, but crypto's the worst. All crypto that isn't a stable coin with actual tangible backing by a legit financial institution will be worthless, completely worthless. At least government fiat will have demand and value because we're all earning in it to pay our taxes, which will also be going up along with our expropriations. So he's a huge believer in the commodity bull market and this big cycle rotation between tech and commodities. Notice that his opinions are also in agreement with what occurred in the 70s. Precious metals and commodities outperform when tech underperforms at the bottom here. It's all in agreement, guys. I don't know how to say this. And I'm like literally scattering my portfolio across the biggest asymmetric opportunities in commodities across the cheapest sectors with the best technical analysis setups. This is ridiculous, guys. I mean, I'm gonna literally 10x my portfolio in front of everyone here and do it on the website in front of all of you, and you're gonna be able to see it. You're gonna be able to see it. So that's what I've got for today. But give me a thumb up for the content, subscribe to the channel, subscribe to the website if you want to follow me and play this commodity bull market and precious metals bull market. I've got the companies. I think I've got the best companies in all these different sectors. My opinion. I'm using fractal analysis to figure it out, and then I look at the fundamentals of the company to ensure that everything is copacetic, is what I'll call it. Everything looks good. So that's what I'm looking at. I'm just going to turn this off real quick, guys. And if you need help, yeah, go ahead, sign up. We still have the discount coupon code going on. The discount coupon code is LEAP, L-E-A-P, 50% off for the first month if you want to try it out. And you get a bigger discount if you go to the yearly membership. If you're on a monthly membership, you can switch to a yearly with this coupon code if you'd like. And if you need help, just shoot me through the contact information on the website. Contact me. But that's what I've got for today, guys. And we'll catch you next time. This is Finding Value.